As promised, Donald Trump slammed tariffs on every country in the world, and everyone from buyers to traders is freaking out. Before we get into this video, I want you to pause right now and comment, do you think Donald Trump knows what he's doing with tariffs? Or is it all just going to backfire in the long run? Whatever the case may be, one thing is certain. If you're holding the wrong kind of ETF, your portfolio will take a beating. But what if I told you there's one ETF that might just stand tall? It's called SCHD, the Schwab US Dividend Equity ETF. Now, this isn't some flashy, high-risk fund. It's more like a slow and steady battleship, built to keep moving, even in stormy economic seas. So today, we're doing a deep dive. We're going to test SCHD against the rising wave of tariffs. Is it truly tariff-proof, or is that just wishful thinking? I know some people believe SCHD is too boring to win. What do you think? Stick around and let's find out if boring is exactly what we need right now. Chapter 1. The 2025 Tariffs. Economic Fallout by the Numbers. For those of you who aren't really aware of the whole tariff situation, here's what happened. On April 2, 2025, the US dropped a trade bomb, a 10% tariff on every single import. But it didn't stop there. China got hit with 34%, the EU 20%, and Japan 24%. This wasn't just a trade decision, it was a full-blown shock to the system. In fact, these are the highest tariffs we've seen since 1910. And the market? It responded fast. And ugly. Apple dropped 7% in a single session. That's a $240 billion loss. Nvidia fell over 5.6%, wiping out another $153 billion. S&P 500 futures tumbled by 3%. The Dow was set to plunge 1,000 points at the open. Now here's where investors started to panic. People dumped stocks left and right. Some ran for cash. Others looked for shelter. But here's the thing. Not all ETFs were crushed. Some held their ground. And one of them was SCHD. So why did SCHD handle it differently? Let's dig into the makeup of this ETF, and you'll see why it's built like a bunker. Chapter 2. Why SCHD was built for this. Sector Strength Breakdown. This ETF isn't chasing hype. It's built with a very clear structure. And that structure, it's what gives it strength during events like trade wars. Here's the secret. Sector allocation. SCHD keeps most of its money in defensive sectors. That means areas of the economy people rely on no matter what. Take a look at this. Financials, 17.82%. Healthcare, 17.66%. Consumer defensive, 14.91%. Energy, 11.86%. Industrials, 10.73%. And tech, just 10.59%. Now compare that to funds that are 40 or even 50% in tech. That's a big deal. Why? Because tech companies are heavily global. They rely on complex international supply chains. When tariffs hit, those chains break, and stock prices fall fast. But SCHD's top holdings, they include AbbVie, Coca-Cola, and Amgen. These are solid, US-based giants. They make things people need: medicine, food, financial services. So in 2018, during the last big trade war, while tech-heavy funds dropped like stones, SCHD dipped just 3.13%. That's barely a scratch compared to the chaos around it. So if you're wondering why SCHD doesn't panic under pressure, now you know. It's built for exactly this kind of economic storm. And that's only the beginning, because SCHD isn't just standing still, it's evolving. let's look at how it actually adjusts itself for the future. Chapter 3: Reconstitution Power: How SEHD Adjusts to Survive. Now, here's something most people don't even know about SEHD. It rebuilds itself every year. Yup, SEHD goes through what's called a reconstitution, usually around the third Friday of March. So what does that mean? It means SEHD doesn't just sit there holding outdated stocks. It reshuffles its holdings to match current market realities. If a company slips or a sector gets too risky, SEHD adjusts automatically. Let me give you a real example. In March 2025, SEHD made some smart changes. It added more weight to energy, up 3.3%. It increased exposure to banks by 3.2%. At the same time, it reduced exposure to semiconductors by 4.1% and trimmed professional services by 2.2%. That's not random. That's intentional defense. Energy and banks tend to hold up during inflation or trade pressure. Semiconductors, not so much. They're tariff sensitive. This rebalancing makes SEHD adaptive, not just defensive. It doesn't just ride out the storm. It shifts its sails and keeps moving forward. So while other ETFs freeze or flinch, SEHD adjusts and keeps doing its job. Chapter 4: Dividend Machine: Income Stability During Chaos. Alright, let's talk income, because this is where SEHD really shines. You see, a lot of people chase high dividend yields, but not all yields are created equal. Some ETFs use risky strategies to boost yield, like selling options. It looks good on paper until the market gets rough. Then the income dries up. But SEHD, it plays a different game. Its yield is real. As of 2025, SEHD is paying a solid 3.74%. And that's from companies that actually generate cash, not short-term trades. Here's the best part. It's consistent. SEHD has increased its dividend for 12 straight years. As of December 11, 2024, it paid 27 cents per share, and the year-over-year growth, 12.23%. That's not just good, it's elite. So let's put it into numbers. If you invested $10,000 in SEHD, you'd be getting around $374 a year in dividends. And if you reinvest that income, it compounds. That's how small gains turn into big wins over time. And during a trade war, when stock prices swing and news headlines go wild, SEHD keeps paying. No drama, no panic. Just quiet, reliable income. It's like getting a paycheck while everyone else is watching their portfolios bleed red. So if you're looking for income that lasts, not just yield that looks good, SEHD is worth your attention. Chapter 5: Volatility Check: Low Beta, High Resilience. Now let's talk about risk, because return is only one side of the story. The other side? Volatility. And SEHD handles volatility like a champ. Its beta is just 0.78. What does that mean? It means SEHD is 22% less volatile than the overall market. If the market drops 10%, SEHD is expected to fall only 7.8%. That's a big deal, especially in turbulent times like these. While other ETFs swing wildly with every new headline, SEHD moves at its own steady pace, and the numbers back it up. As of April 2025, SEHD is actually up 2.93% for the year. That's despite all the tariff noise and global uncertainty. Why? Because SEHD doesn't overreact. It avoids exposure to tech, keeps its portfolio defensive, and rebalances smartly every year. In short, It stays cool when others lose their heads. And that kind of stability, it's rare, especially right now. But don't just take my word for it. Let's put SEHD through a real world test. Chapter 6 Stress Test Scenario SEHD in a multi-year tariff cycle. Running a scenario. Imagine we're in a 3-year trade war. Tariffs stay high. Markets stay messy. You invest $10,000 in SEHD at the start of it all. What happens? Here's how the numbers play out. Year 1, market adjusts, but SEHD still returns about 8%, $10,800. Year 2, things stay tense, but defensive sectors hold up, $11,664. Year 3, the cycle continues. SEHD compounds again, $12,597. Now add in dividend reinvestment over those 3 years, and your total hits about $13,200. Not flashy, but safe. And most importantly, reliable. Better than most volatile funds out there. Compare that to a tech-heavy ETF that drops in year 1, then scrambles to catch up. You're playing defense and offense at the same time. And here's another angle. Many investors try to time the market during trade wars. Buy low, sell high, right? But timing is tricky. Instead, you could dollar cost average into SEHD. Buy a little each month, ignore the noise, and let the fund do what it does best. Protect, pay, and grow. Because even in a multi-year economic mess, SEHD proves one thing. Slow and steady doesn't just survive. It wins. Chapter 7. The Big Picture. Is SEHD really tariff-proof? Final verdict. So, is SEHD really tariff-proof? Let's think it through. It's got a defensive sector mix. Healthcare, consumer staples, financials. These are things people still use, even in a crisis. It has low tax exposure, just 10.59%. So it's not dragged down by supply chain chaos. It rebalances every year, keeping only the strongest companies, like Coca-Cola, like Amgen, like AbbVie. Its dividends keep growing for 12 straight years, and it has a low beta, so it stays calm when the market panics. Plus, it's cheap to hold. Just 0.06% in fees. So, is it 100% immune to tariffs? No ETF is. But SEHD? It might be the closest thing we have. And now I want to hear from you. Do you think SEHD is the smart move in a trade war? Or do you think it's just too safe to grow? Drop your thoughts in the comments. Let's get a real conversation going. Because smart investors don't just follow the market. They understand it. And SEHD, it just might be the ETF that proves boring can be brilliant.